Good morning, gentlemen, and good morning, special lady in this group. Welcome to a roundtable discussion on a very emerging, on a hot topic, a topic which is emerging, but which we learned yesterday is very hot. That's the topic of co-lending. My name is Manoj Agrawal, and the group editor at Banking Frontiers magazine. And we have a physical magazine, we have a digital magazine, we have a video channel, and we are active on LinkedIn and maybe on Metaverse or something. You may see us in places like those as they emerge.
Yeah, good morning. I'm Naresh from New Street Technologies. I take care of the business development.
Welcome, Naresh.
Hi, my name is Ganesh Kotian. I'm part of Aditya Birla, close to 7 years now. Prior to this, I just shifted to technology. Prior to this, I was instrumental in setting up housing business.
Okay.
Yeah.
Okay. Wonderful change. Thank you. Congratulations.
Hi, good morning. My name is Durgesh. I look after products in SBFC Finance Private Limited. I am there since inception of this company. We formed 2017, September. Before this, I had my own startup. So I got acquired in this particular company. So Mr. Mahesh acquired me. He will introduce himself. Yeah, Mahesh.
Wonderful. Good to know that background.
Hi, good morning. My name is Mahesh Dayani. I've been a career banker for almost 2 decades between wholesale, retail. I've had the opportunity to work with ICICI, HDFC, and I was the country head for ING before it got merged with Kotak. 2017 is what we co-founded SBFC along with Asim, and this was largely a slum sale. So we're largely into secured lending, and over the last 5 years, we've now churned this up into a 4,000 crore company.
Fantastic.
Hi, good morning, everybody. My name is Vikrant Narang. I'm the Deputy CEO for Ambit Finvest. My career is more than 23, 24 years now, both in large ticket wholesale lending as well as retail lending. Been through organizations like ABN AMRO, Barclays Capital, KKR, and with Ambit Group now for more than 5.5 years now. We are a retail MSME-led NBFC. We do largely LAP and unsecured loans. The balance sheet is in excess of about 1,900 crores right now. So it's small ticket loans. So that's what we are building as a business over a period of time now. Thanks.
Good morning. I'm Dr. Ravi Mudani. I'm the founder and CEO of 121 Finance Private Limited. That's India's first NBFC factoring finance, which was certified by RBI this year as a NBFC factor in April. So we've been into digital B2B lending for the last 7 years, working capital lending only. I'm a third generation entrepreneur. I'm president of currently TIE Rajasthan, which is a Silicon Valley based startup. We are doing startup mentoring for these startups by these startups. Pleasure to be here. Thank you.
Fantastic. Thank you, Dr. Ravi.
Hello. Good morning, everyone. My name is Shirish Lal. I'm the Chief Business Officer for New Street Technologies. Great to have all of you here.
Welcome, Shirish.
Hi, good morning. Sajeev Vishwanathan. I'm the CEO and founder of New Street Technologies. I'll talk a little more about our company a little later.
Sure, Sajeev. Welcome. Can we have the mic?
Good morning, everybody. This is Jitendra Agarwal. I bring in 31 years of experience in different industries, specifically last 11 years with HDFC Life in bringing business excellence using disruptive digital transformation innovations. Prior to that with ICICI Bank, bringing and transforming their collection business. So relevant BFI experience along with manufacturing and retail. I've been currently associated with Banking Frontier in terms of various panel discussions and bringing in those supports which are required for Finovity, Technovity side of it. I'm right now a founder of a company which is Relevanta Solutions, which is in the space of digital transformation.
Thank you, Jitendra. Welcome.
Morning, everyone. Arun Prasad, the Chief Operating Officer for New Street Technologies. I've got about 27 years work experience, mostly in capital markets, mutual funds, insurance, and then, of course, MasterCard on the payment side.
Welcome, Arun.
Good morning. This is Ashok Kumar, consultant for New State Technologies. Earlier role, I had 4 decades of banking, IT, payments, and information security experience. I was working with Karur Asia Bank earlier.
Welcome, Ashok. You have a mic there.
Good morning, everyone. This is Archana. I'm a banker for last 20 years. So under risk management only, throughout corporate, SME, and retail. Currently, I take care of mortgage businesses and the rural part, and definitely the co-lending, which we have recently started. So looking forward for this conference.
Sure, welcome.
Hi, good morning, everyone. My name is Murthy Chitlur. I'm heading the client delivery for New Street Technologies.
Welcome, Murthy.
Morning, everyone. I'm Kishore. I'm part of the product team in New Street. Previously, I would work with the microfinance, financial inclusion, and cross-border remittances for more than 10 years.
Okay. So we are going to go through an interactive session for the next couple of hours, or faster if you can. And we have with us New Street Technologies, a Bangalore-based IT company. There's something special about them. They're part of being RBI's cohort for Sandbox on MSME lending. Plus, they're working in this area of blockchain, and they're not trying to create another cryptocurrency or a Bitcoin for all of us to trade in and create insane valuations or something like that. They're actually trying to solve problems that are real problems, down to earth problems. Let me begin by asking our CEO of New Street, Mr. Vishwanath, to briefly give a background to explain his perspective, how he landed up in this and why he landed up in this area, so that we can then see and delve further into this whole issue of co-lending and blockchain and the associated business and vision and technology part of it. Sajeev?
Thank you, Manoj. The blockchain world was introduced to me in Earthport, where Ripple, many of you probably know Ripple. Ripple is said to be the leader in cross-border payments using blockchain. And they used the correspondent banking network of Earthport to do the first transaction ever. And I saw the technology and I said, it's got some phenomenal elements. And everything comes down to trust. And trust, if you take the trust coin and flip it, it is risk. So risk is what NBFCs and banks are good at doing. And then if you roll the coin across, it touches a lot of people as it gets distributed. So distributed ledger, distribution and risk is the other name of financial services. You add collections to it, you've got a full lending product. So blockchain inherently is all about trust, distributed trust, distributed processing, and in that we found that there is a perfect match for everything on financial services to move to blockchain, and we think it will. There is no doubt. We're seeing the first few elements of it. We've created a decentralized, anonymous, autonomous chain organization, which essentially means that multiple participants without prior knowledge or interaction with another partner can work together to complete a transaction from end to end, and completely immutable transaction, which allows anybody to work with anybody literally. We're breaking the mold in terms of who you should partner with. How can that lends itself to co-lending? Two partners coming together and on a perfect platform which gives you everything that immutability, the ability to see through the end-to-end transaction from wherever you're sitting, allowing people to participate in it at your will, and also allowing people to contribute more than your fair share of contribution, or take out value from it, disproportionate share of value, depending on what the end transaction looks like. So these are some of the things that blockchain has evolved into. We're probably about 1.5 years ahead of the world where blockchain is today, thanks to the amazing team that we have. Some of our investors are also blockchain stalwarts in the US.
I think Sajeev has already explained what we are doing. So I'll come narrow it down to this particular event. What happened is that while we were doing a lot of stuff on our blockchain-based middleware, and we were working with our partner banks and cracking use cases after use cases, we came upon a very unique opportunity and we applied for it, which was the RBI Regulatory Sandbox Cohort 3. This time the cohort is on MSME. And we presented our concept of the platform, and we specially chose co-lending. And we were one of the 8 participants which got selected. And as we speak today, we are testing the co-lending MSME model in the RBI sandbox. The phase 1 test. Yesterday only I sent the report. So this is the background. So this, when this happened, the entire team got into research mode. We thought about it. We got industry experts to talk to us, and we realized that this is not a very small problem. This is a very, very large problem. So if we see all this risk, we saw that the co-lending model which is getting proposed is a very ideal situation. Okay, these 6 risks which we have pointed out, they are getting solved with the co-lending model per se. And going forward, you'll see co-lending has enormous benefits for everyone, whether it's a bank, whether it's an NBFC, especially the consumer. You know, it's a win-win scenario for the complete industry which is there. But the question which I want to stop my conversation here is that why? What is slowing the growth of CLM? Apart from the discussions which we have already had, what are your views individually and as an organization that why it's not reaching its true potential?
Thank you, Shirish. So let's look at this question in the context of $1 trillion gap in credit that industry research has shown up.
You know, I guess while the initial circular came out in 2018, but just to set a context, I think there's 1 trillion, 20% is addressed, 80% is not addressed. And that's a data that's been going on for years now. The structure, if you just probably break down the structure and if you really look at it, so banks have fantastic capital. NBFCs have never had a problem on the asset side, it's the liability side.
Mm-hmm.
So, you know, if you are a non-corporate backed NBFC and now with the merger of banks, you have 25 odd lenders that you can actually borrow from. If each one of them takes an exposure of 200 crores or 300 crores, you are closer to 6,000 crores. You have your own capital of 2,000 crores, 8 to 10,000, your game is up. So where do you get that capital? If you're non-corporate, and now if you know people who've been with banks will tell you, madam's been in risk, there is an exposure cap that they was going to go down on NBFC. So how do you address it? So structurally, if you look at the circular which was done in, it was with the right intent, saying that we need to fill in that bridge, that gap, MSME gap. The second, if you look at, this is publicly available data, look at the PSL, all banks meet the PSL targets, but the sub-targets are not met. So as a result, you will see a lot of banks investing heavily on RIDF bonds. And if you probably flesh it out further, even banks like SBI invest almost 7.5% in RIDF bonds. Even the private banks range anything between 3.5% to 7%. So which means that if your sub-targets, which are classified between small and marginal farmers, MSME, which is small micro enterprises, if they are not met, they end up either investing in RIDF bonds or obviously you have the PSLC certificates. Now that's a gap. So technically, all the banks will have to fill in those gaps. NBFCs on the other side don't have capital or they don't have large amounts of capital available. So this seemed to be a perfect mix.
Right.
Unfortunately, so there's an RTI application made by some individuals, and till 2021, the total amount that got lent under that program was only 136 crores by the largest bank in the country. If you take the third largest bank in the country, the number was even below that. So what actually didn't happen?
Yes, his observation is right. Even public sector banks have not invested, have not disbursed the loans, and they take the easy route of bond investing. Okay, let me tell the challenges what is faced by them. One is the cost of originating those loans, and no focused interest. Easy way for the compliance is finally go and invest in the bonds. So the main aim of this co-lending is that yes, banks will have 1,000 works to do at the branch level, because finally what and all we say, we issue circulars and we issue directions from the corporate office. It is the field force which has to do it. Here is a solution where as a bank or as an NBFC you enroll to our systems. We do majority of work. Simply the role of NBFCs or banks will be only the financial aspect. And this technology plays a major role wherein which, as Ajay was telling, even though you have the co-lending models workable in a non-blockchain technology, but this one technology gives the same view of the entire transactions or the customers across all the participants.
I have a question, an observation. You mentioned co-origination more than you mentioned co-lending. You did that on purpose. There is a reason behind that.
No, there's no specific reason. Co-lending, if you're referring to the 20 circular, the only changes that is coming through saying that now it's going to be discretionary, which means that it's going to be akin to a DA route. So whatever I originate now it goes into a DA, which was not in the first circular.
Right.
Yes, the second circular, right? Second, they've obviously included priority sector classification and home finance companies. So they've tried to make the operation a lot more flexible, which was anyway the case earlier. So if I wanted to do DA, I could have already done a DA with a 2080. So, so operationally it's become convenient. I really don't know whether I need to really invest in that technology or anything. But my experience was more to do with the co-origination for the last couple of years that we've spent in really building it. Now, and retail is you have to invest in it for at least 3 to 5 years. It is like your typical Chinese bamboo, where for first 5 years you don't see anything, and another 3 months it shoots up to 60 feet. So that's retail. And practically what you see is that if anybody tells you that in retail what is your ROE at the end of 3 years, that's not going to happen. But yes, you start seeing that come into play from the 4th and 5th year onwards. This is exactly what's going to happen with co-origination. And it's very important for the other partner to be actually patient enough, because he is going to be there in it for the long run.
Correct.
A DA is a transaction specific.
Correct.
It is not a partnership. It is not a continuity. It's a securitization transaction.
You sold it.
I'm done with it.
Yes.
Okay. So if I was selfish and I was talking about my company itself, I would want the other partner to be equally committed if my skin is in the game for the 20%, because I'm just not doing a disbursement for the month. I'm planning for the next 3 years. And that is the reason I would want the co-origination to work for me. Obviously, what's happened is that the second circular gives the confidence of the NBFCs to go ahead and lend. But that is again transactional. That's not partnership. That's my limited.
Understood.
So the private banks look at it as I say, it is a long-term relationship. So when they just look at the NBFC, they see first that what is the rating. So rating comes in the fact that how they can originate, how they source their books, and then whether they have a good standards of underwriting. And the third part is the collection, how they are able to collect. So the private banks looks at the last 2 years or 3 years, 5 years vintage, and then delinquency numbers, which if it is a security, what kind of LTVs are there, what a kind of FOI is there. So it is based on the two-way relationship where I am not there, where the private banks are not there geographically present, they do that kind of a relationship, and where the products, which if I talk about Yes Bank, it's more retail has recently started. Last 5 to 6 years, the retail was there. So I'm not there maybe in a two-wheeler segments. I may not be there in the used commercial vehicle segment. So the segment which I'm not there, I try to look for a partner who is already established. So the risk reward portion which we are talking about, it comes from the quality of the portfolio which the NBFC is already managing. If the portfolio quality is good, definitely the portion of the reward and recognition will be on a higher side, because the collection ultimately has to be done by them. I mean, the private banks come into the picture where everything is gone off with the NBFC. Then only they patch in. Otherwise, everything, the collection, the monthly disbursement, monthly collection, and then if the account goes bad, also those legal things also to be taken care by them only.
Let me set the cat among the pigeons. What's in it for you? What's in it for a bank? You can do a term loan for the same amount, and you'll be looking at portfolio quality, etc., to do the during your due diligence. But your job is over. You give the term loan and wait for the payment or interest servicing, and that's all that the bank has to do. What is it? What is co-lending going to do different for you as a bank?
So
NBFC makes a big difference, but bank, what would be
okay,
your
for
thoughts?
for an NBFC, definitely they get a more capital, they get more money to lend and then grow their book. For a bank, it is cost effectiveness. I mean, it is almost kind of a very minuscule operational cost. I don't have to employ my sales force, my credit underwriting team, and my collection. So it's kind of a we look at it as zero cost kind of a acquisition model. If you do the retail, you have to pay to the DSAs also. So it's this model is a long term investment. For first few months, you have to invest. I mean, look at the underwriting standards, and it's regular. It's not that I have just made a policy and then I'm gone.
No, I get the point between you doing a retail book yourself as against a co-lending.
Exactly.
But what about
That's a cost
co-lending
effectiveness
versus a term loan?
So I think Mahesh made some very, very relevant points. I think fundamentally, whether this model is very attractive on both sides, just coming from NBFC side, I think he made some very fair points. And one of the fundamental points is around leverage, right? If you go pre-2018 era, NBFCs were leveraging their equity, upwards of 5, 6, 7 times, right? Post that era, obviously, because of heavy bias which they took towards short-term financing, the cookie crumbled at that point of time, and therefore the risk managers at all the banks realized that we need to reduce the caps, we need to bring down the leverage which we will extend to this market segment, right, to the NBFC segment. So I mean, if you're a typical NBFC, I reckon you would be anywhere between 3 to 4 times before you are toppish in terms of then you again need a capital raise, which becomes dilutive for the existing shareholders. So how do you become more ROE accretive? The questions which we keep asking ourselves internally is that reality is if you go hit the market again and if you're showing a very abyssal ROEs at a fully leveraged state, then there is no future, right? I mean, the new investor is not going to come in and you start expecting 2, 3, 4, 5 times in terms of your price to book. So that becomes a sort of a, you are in a flux then, and then you continue to then correct your models over a period of time. It will push you back into from a market timing standpoint. So therefore, this co-lending opportunity becomes a kind of a very elegant solution in that scheme of things, because you're effectively, by taking 20%, you are, effectively taking higher 2 or 3 turns of leverage on the same capital, right? So effectively, you're trying to achieve a, say, 5, 6, 7 times outcome on a leverage standpoint on your own capital, which means that you will start seeing ROEs become more attractive. So hopefully you start inching towards a mid-teens ROE in a NBFC segment, which becomes quite attractive. When you are taking your business for a fresh round of financing, right, or a fresh round of equity financing.
Co-lending is all about, as far as I can see, it's gone towards unsecured and LAP secured kind of. Do you see co-lending coming into, more instrument-oriented stuff like factoring and invoice discounting and so on.
Absolutely. So I was trying to say basically NBFC is about domain expertise, right? So we've been talking about labs and secure lending. What happens to people who are doing, let's say, gold loans, or today what we are doing as a factoring, right? So in fact, we have been talking to people in terms of the banks that why can't we do a co-factoring? So we have a legal opinion that we can do a co-factoring with the banks because, of course, the NBFCs can't do factoring until unless they have an NBFC factor license from the RBI. So we can't partner the NBFCs for co-factoring, but we can partner the banks or the small finance banks for co-factoring, right? So the important point here is the NBFCs have a domain knowledge, distribution knowledge, as well as they provide the dispersion to the banks, unlike the concentration. So, I mean, I go back to 1994 Bill Gates statement, the banks are not required, the banking is required. Banking is required, right? So maybe what we have been seeing now is the dismantling of the asset side of the bank, when the NBFCs pick up the lending or the payments are taken care by Reserve Bank of the world, collection are doing something else, right? So there's an entire dismantling happening, right? So I see there has to be understanding between the banks and the NBFCs for specialized products like factoring and, for that matter, in terms of CIBIL score. So what we bring to the table is something very different in terms of disclosed factoring or undisclosed factoring, right? So these are all not loan products. They are working capital trade products, So we do unsecured lending. And the banks also have to understand this model of underwriting. I mean, they do it themselves, but they have been doing for corporates. Now, this is a huge opportunity at the bottom of pyramid where there's the missing gap of the credit gap is there for the MSMEs, right? So we operate into the SME part and the, the medium part of the MSMEs, not the micro part. But there's a humongous opportunity because I guess the PSU banks have left that space of a branch-based working capital limit, right? So where does that entrepreneur go for a working capital limit? And I believe factoring is one of the product, or rather the only product to manage the working capital because you are taking a call on the stronger repayment capacity of the buyer, right? So especially for the when the MSME is supplying to the corporate, right? So we have seen trades platform operating here, but there are many use cases where the trades cannot perform. So for example, a corporate cannot be a seller on a trades platform. Only a MSME can be a seller on the trades platform, right? So for example, a corporate to corporate factoring cannot be done on trades platform, right? Similarly, there are many use cases which cannot be completed on the trades platform. And there's a huge opportunity for the banks to partner for specialized lending like factoring or gold loan, whatever it is, in terms of co-factoring. Yeah.
Ashna, what are your views as a risk officer on those kind of products?
For factoring purpose, it is a very short-term kind of a lending, 90 days lending. And one thing is there that it has to be done under CLM1 model. There are two models to it, CLM1 and CLM2. CLM1 is a parallel underwriting. Underwriting by the NBFC and by the banks at the same point of time. Okay, then only it gets dispersed. So this requires a technology much more than the CLM2. Otherwise, it will not work. So the technology is one piece, which is a hindrance to the factoring. And the second part is the pricing, which I feel, because when you go on the trades platform or the factoring, the pricing is very, very fine. So it doesn't, for NBFC, that is why they don't enter into this space. It's the 8% or sometimes it is 7 or 6%, I believe. I think everybody will agree to that.
So I think most of the things are already covered. What I see this space is very exciting. In terms of, there are three things which people get benefited with this. One is the bank who don't want to get into this sector. There can be such institute also, right? They get exposure because the risk and the USP of lending to that particular sector is already been tested by the NBFC. So the problem with the NBFC is that, again, mentioned earlier, is the cash part of it. They don't have liquidity to fund those sector. From a customer point of view, yes, if a small NBFC would have funded higher spread because of the credit loss and XYZ things getting considered, so here they can lend at a much competitive rate. For a bank which wants to get into this particular space, okay, for them this is a test period. They can do it with this so-called collaborative way of operating, and they can learn the business and they can actually expand in this space as well. the most important thing, I think these things are already covered. The most important thing is that how do we expedite the whole process? Okay, there should not be a two level of so-called underwriting or anyone getting into, because end of the day, we are into a very conservative banking space. You know, everything we talk about risk before doing any lending, right? So this type of technology will help even when we talk about factoring or anything like that. The most important, the crux of the whole matter is that how fast you can lend and how accurately you can assess the underwriting. So that is what, to me, it's very important.
One add-on question to the point that you made to Archana, to the bank, is human skills, competencies an issue as you expand into more products and more regions? Do you think banks, if you exclude the large ones like SBI, which are present all over the place?
Now, as an ex-banker, I fully agree. The biggest challenge which all banks are facing is the skill set at the branch level. Because this many products, this many rules, people don't remember.
So in the sense,
And if you have this,
partnering with NBFCs for the skills also.
No. One is the
Not
skills.
just the
No.
business.
One is the skills. Another is the platform. I don't say platforms. It's softwares, because if the software teaches you how to lend, because it is not easy to groom a branch manager. Minimum 5 to 10 years of efforts, and with job hopping, it's a big challenge. So banks does not want to take the risk of giving those things to the at the human level. Let me share my experience, because I will share with you the speech made by Karvesha Bank MD. Because we have this problem of NPAs, there are two things. One is the corporate, nothing is in your hands. Another is in non-corporate. One of the biggest challenges we faced is this skill set, because one is the assessing the people when they visit the branches, and then underwriting. The skill set over a period of time has gone down, which has finally resulted in increase in NPAs. So it is proved in case of KB, because digital lending is there for more than 5 years. Our NPA levels has come down drastically.
I think, Manoj, to me, the most important thing what I see is that it's not about knowledge gap, it's about individual risk capacity also many a times, right? When you do underwriting, actually nobody onboard a risky or a bad customer. We always onboard a good customer based on the profile and all, right? The most important thing which I feel is that when something goes wrong, of course, human tendency, we go and check who has underwritten those things and all those type of things. Of course, knowledge gap is something which we all face. But in a technology world, if anything goes wrong, you go and fix those algorithms, right? You work on those machine learnings and all, right? So these are two different things, right? So according to me is that, of course, when it is machine getting fine-tuned, that is accepted. And I feel that is how it's going to overtake the... That's my way of looking at it, because when a individual underwrites things going wrong, we say that okay, there's an underwriting issue with that particular individual. But when we talk about machine, we keep fine tuning it and we invest there, but we don't do it. So automatically the risk capacity appetite goes down at the branch level, according to me.
I think before we jump in there, one of the constituents we cannot ignore is the regulator. At some point of time, let's look at what the regulator will be interested in also. I'd love to hear your feedback. Is that part of the flow?
Actually, it's part of the flow, and we'll touch just listing out few existing models of technology and limitations in relation to co-lending and direct assignment, very, very particularly. Now we have, I still believe 90% of the world is in the first model. Okay, there are ERP systems at both end. LMS, LOS at NBFC end, CBS middlewares at bank end, and they are it's completely manual. There's an Excel sheet email getting shared, and it's a very high OPEX model at both ends, because you need makers, checkers, recons, audit, everything done. And most of the regulatory compliances which have come over the time have not been, they don't get fulfilled. So you'll see regulatory compliance as the key aspect here. For example, why DA has slowed down. I hope all of you will agree, because now regulator wants you to have real-time NPA tagging. Means not at the end of the month. On the date the NPA matures. Correct. So on the day, and that's why NP has slowed, direct assignment has slowed down. And still now we have not seen a technology which helps you mark the NP on the same day when the NBFC closes the EOD. So if the NBFC closes the EOD, the bank should come to know, but technology is not enabling it right now. Now coming to the second model, which a lot of banks have invested huge amount of money, which is the one-to-one API integration. Now API is called the banking change in the banking industry for 4-5 years, but it's a very, very expensive process. It's a repetitive process. It requires huge efforts at both ends. You have to consume APIs, you have to rectify your APIs at the bank end, at the NBFC end, you have to maintain protocols. There is a middleware which takes care of the API. If any changes on the Android version or anything comes, then the entire infrastructure goes for a toss. And then every time as a banker, ma'am, you will know that, CISOs and the IT security issues for opening up the channels for API integrations it takes 6 months, 9 months, sometimes 12 months to integrate one partner. NBFCs must have also experienced this. Who will wait for 9 months and 12 months for integration? If Slice would have waited that long, for example, the business case would not have existed. For just an example. So that is a limitation of the one-to-one API integration model. Now there are 2-3 very important points which we should discuss apart from the regulatory compliance, which is extraordinarily important, is the cost of operations. Now, because there is data dependency, still there is no way where data is trusted data. Means it's not that banks and NBFCs don't have trust in each other. They are both regulated entities. But the risk of non-compliance is very high. The penalty on non-compliance is very high. Hence, the trust is not there on the data. Then the accounting, your schedule creation, your appropriation sequence, your collection account reconciliation, your disbursement account reconciliation, all these things have to have a middle office. There's a huge team of people in banks and NBFCs just doing all these activities, adding to the cost. And finally, now there's another platform kind of a concept which is coming in the market. There are companies which are offering platform. I call this man in the middle platform. So all they have done is they don't want the platform says don't integrate with each other, integrate with me. Okay, but I will take the Excel sheet from the NBFC, convert it in how the bank wants it and send it to them, and vice versa. So it's a man in the middle platform which actually doesn't solve any regulatory compliance. And there is another new risk which is born, which is the information security risk. You are handing over your information to a third-party platform for interpretation. How in any financial institution, that is unacceptable. In regulatory compliance, that is unacceptable. You're giving somebody else access to your data. So all these things are what are the current platforms which I wanted to present here, and their limitations which are holding back the co-lending and direct assignment. Sure.
So basically how we do that and how we look at it is we break it into 3 parts. First part is my origination, right? So origination is in LOS, which might be a part of LMS, or it can be a standalone software altogether. So in LOS, how we look at it is we look at a phygital model. When we reach out to a customer who is, let's say, sub 10 lakhs customer, sub 15 lakhs customer, not all his documents are digitally present, right? You have to meet the customer physically, understand what he is doing. You have to look at his shop, you have to look at his stock, and you understand and do a credit underwriting. So that's the first part. Once you have met the customer, you have to process their loan, right? So the processing of loan has to be as digital as much as possible. If the customer is filing an ITR, you get a FinFort integrated. If you have got a bank statement, you get a Perfios integrated. So if there's a CIBIL, obviously, which is there, you get all the data from all these factors. So based on the physical assessment as well as a digital assessment, you give a go ahead. How we do it is, and what Mahesh was telling, it's a co-origination. Once we get all this data, we have integrated via API with our channel partners. So the data flow happens at that particular time, decisioning happens at that particular time, and what we have done from operations perspective, It has become very simple in that aspect. Third aspect is, once the loan is processed, how do we service the loan? And for that, we have created a middleware, right? And that middleware is just not for co-origination. We can have a portfolio of any other company, which we can service as of date. So we have got a LMS platform that we have built. And with that platform in place, we are open for servicing any particular company for all types of loans. So we have built a master data set, which has helped us. So we have understood maybe for 1, 2, or 3 assignments, we got certain data sets, but as of date, we are very confident that we have got a master data set. Tomorrow, if you'll tell me plug and play for this particular company, we can do it in 5 days. So that is something that we have achieved and we are very proud of. So that is, I think that's a mix. So when you see, there's a physical model, there's a API integrated digital model, there's a middleware. All these things in place are helping us to build that. So I think that would be an insightful thing to discuss, maybe if anyone has any point.
Clarification question.
Yeah.
You said any company can adopt your platform.
So we are not selling it in open, but we have built that platform where we have an integration. For example, tomorrow, let's say Yes Bank tells me, okay, I've got a portfolio of let's say 1,000 crore and I want you to service me. We can integrate with Yes Bank within 5 days because now we know what all banks have in their data set. 1 or 2 elements here and there from API perspective, yes, that will be an add-on, but 99% we are there where we can start servicing from tomorrow.
So just to give you a background, we have something which is called loan management service. And the way it's structured is that earlier you had a lot of securitization transactions. Now, because of the ILFS, DHFL crisis, the originator of the loan, if it ceases to exist, then your pool gets downgraded. Okay. Now, it's very prevalent in the US and developed markets that there is a concept of a backup servicer. And the backup servicer steps in once the originator ceases to exist. So, currently, for all securitization transactions that happen, whether it is done by banks or they are done by ARCs or they are done by any of those companies, even the SSGs, the avenues of the world, they will need to sign up on a backup servicer to ensure a rating of the pool, because what you do is you take a pool and you rate that pool. So we come in as a backup servicer to ensure that the rating of the pool is standard and it doesn't get diluted even if the originator tomorrow ceases to exist. So that's one. Second, I think we've taken portfolios, or rather we are servicing portfolios for a lot of ARCs who have taken over the portfolios, and we are now acting as a servicing agent. What it doesn't mean I'm a collection agent. I'm a servicing agent. And the data comes in various multiple formats. Somebody says, the way the name is written, the way the address is written. So someone writes the surname first, the second name subsequently. So there are multiple formats, and our state of readiness is that tomorrow if I have to integrate with any organization, I can do it on a fly because now the structure is a lot more modular.
But internally, is it everything automated or there's still some manual work?
I would say largely is automated. Okay. It could be that when you are getting into a transition phase, there could be some parts which could be manual, but otherwise the entire process is automated.
So, I was just making one point when we were discussing the recommendations which came up after the research is that, what is required in terms of technology to unlock this. Say, for example, imagine there is a system which has no dependency on data. Okay. So whatever you're talking about right now still has push dependency. Somebody has to send the data. Okay. So whether through API, whether through Excel, you have to send the data. Say if there is no dependency on somebody sending the data. It's not a pull, it's a push data fetch. As and when the data is generated, whether at any stage from origination to collection to NPA. So say where the regulatory compliances as per the changing regulatory compliances. Now this is a discussion which Saji also wanted and I want all of you to pitch in here. Regulatory compliances are today and they are so dynamic that they are changing. The system needs to be in a way which adjusts and be flexible and be versatile to adapt to a new regulatory compliances. If household income calculation is given, you should not take 6 months, 1 year to do that household income calculation. If real-time NPA tagging is required for DA, it should not take 6 months, 1 year to do that. It should happen instantly. It should happen real time. So your system inherently has to be flexible to accommodate regulatory compliances if this needs to grow. And now coming to the automated unified process. Now we were talking about double underwriting is not possible. We were talking about a lot of things which is required. What if a system enables a unified underwriting? Why to do a double underwriting? Why the bank should check after even some time and do a due diligence on it? If the system enables you to automate your unified process, which is from origination to collection to recognition of NPA, your system acknowledges the BRE, the business rule engine is common, agreed. Once you sign it, when you code it, then you don't have to worry about checking it. And it has to be immutable. So it should be something which neither the NBFC nor the bank can change.
Can we have some inputs, maybe one minute each from all the NBFCs and banks here, in the partnerships that you've already done between your organization and an NBFC for you and a bank for you? To what extent was technology consuming a lot of time or a lot of resources or a lot of skills or a lot of compliance issues? What did you really struggle with technology on?
So, see, for me is that what I have experienced, I don't want to quote one particular organization where specific things we have seen is that the data authenticity is something which is very important.
Data authenticity. Okay.
Yeah, because what happens is that you don't know whether this particular, the portfolio which you have taken, and if it's served by somebody else at the moment, so you don't know the collection DPD movement and all. Okay. What he mentioned just now is that it's a real time, right? There can be a situation also. Forget about. Keeping this aside, many a times it's unlike banks, where your UOM process, end of the month process, may take some time. But with this particular platform, the data is completely synced, both the ends. Right, both the partners, both the entities are aware about what's happening for that particular loan account. So
data validity and speed. Both.
Yeah, speed. It's real time. It's appearing in both the screens together. There is no nanosecond gap. Also, that's what I feel in this particular.
So I think we were the first in the country to do the coordination with the banks. So we struggled a lot. From technology perspective, I would not say we did not struggle. We struggled a lot. It took us more or less almost 6 months to get it 95% right. I would say 95% because we are still learning. So that is there. That's a steep curve that you have to anyway go about it. And everything, the accuracy has to be paramount. Same time, the data view has to be paramount. So these things are very important because the customer, when he's sitting at the branch, he doesn't know piche mein SBFC hai, he doesn't know which bank is there, right? At that time, he needs his amount in hand. So that became a very crucial part for us. If we have taken a document, it has to be processed in the right way with the most accurate data so that at the end of the day, both the banks and the NBFCs are sure that we have lent it right.
So when you have that, when you're working towards that partnership, do you have quick response from your banking partner?
So initially, I think both of us were learning. I would not say that day one everyone was there, right? We felt we were lacking something. We felt the bank is lacking something. So we both learned, and today, fortunately, we have come to a level where we know ki, so for example, initially when we started, fund transfer used to happen like 3 days down the line, even if after the sanction and all the documents had gone, right? Then there was a API integrated where we passed the agreements, everything online to them. Then their team did it in 1 day. Now they know, and we have come to a mutual agreement. If we have disbursed it, they have disbursed it.
Okay.
So the fund transfer is real time now. So that has evolved in last 3 years. Like we can't say day one, any bank will also trust you for that matter, right? And that's a process that will take its time. But from a proper tech perspective, it will take time because an understanding is required, compliance is required, bank's compliance is more than the NBFC compliance for that matter, right?
Yes.
So we have to add up on those parameters, which we did not have for that matter. But yeah, that takes time. That will not be done overnight for sure.
Got it. Thanks for the explanation.
I think we are still struggling in terms of the integrations with the banks. So it's not easy. I mean, whatever name, shape, form you call it, just two organizations talking to each other, whether it is double underwriting, whether it is trying to synchronize policies, funding at the same time. I think it's a nightmare. I think it needs improvement in every aspect. Maybe I think you guys have cracked the code much ahead of us. But we are still maybe year and a half minus in terms of engagements with the bank.
Ravi, you have something to share?
So I think similar experience with the banks, because I believe that the NBFCs sometimes are ahead on the technology curve as compared to banks, especially in terms of integrations are concerned, right? So they don't match sometimes, so it takes a lot of time into integrating the APIs and stuff like that. So
data availability, then the validation of it,
okay,
and then the accuracy of it, and then how the data is flowing to. So these 5 things we struggle a lot. Today also it is not very smoothened out. There is a time when the data of delinquency or the check bounce status, everything is by a 1 month lag.
Oh.
Whereas the bank needs to have a daily thing.
Yes.
One instance I tell you, there is when you present a check, the customer is in, let's say, in a 10 days DPD or 30-day DPD. You present a check. The NBFC, what they do is, or what their processes is, they put a check in the bank and then DPD gone. Whereas the bank, what they do, when they realize the funds, then only the DPD has to be 0s. So this is a typical example on the practices followed by NBFCs and the banks are
There's
different.
so much duplication.
Now, what happened if the check bounce? It will come back to the DPD again.
Yeah, correct.
So there are challenges definitely, but yeah, the journey is there.
So I think that's a good compilation of the challenges.
So before getting into the details, I would like to just walk you through a couple of minutes about like why really blockchain is. So I think everyone has got to know about the blockchain by the word Bitcoin. So then it started becoming a synonym, but obviously it is not. So let me not get into the Bitcoin part at all. So it is just a cryptocurrency, which is just one use case on the blockchain technology. So what blockchain is all about. So of course, when it comes to that one, again, blockchain, it's not a new technology. It is a existing technology presented in a new form to fight or to find the solution for the existing problems in the financial industry. So there are many important features which blockchain provides us is like immutability, decentralization, tokenization, and single source of truth, etc. So whatever we have been discussing now. So, and obviously like there are like different platforms what we have been, it's happening currently in the world about like public platforms, private platforms, and hybrid platforms. So obviously coming to the discussions what we are doing, the enterprise platform or the private platform is the best suitable blockchain platforms. So addressing to like when everyone have been discussing, I see that most of the points pinpointed it into the real-time data, reconciliation, data accuracy. So everything is the inherent features of the blockchain, what blockchain already has it. So how we are using that features and trying to solve the problem. So I should like to bring one point over here is this platform what we have built and what the use cases we are building on that particular platform. It's not an overnight invention or discovery. It has come with decades of experience with our founder and of course our team members who have been coming from the industry with a lot of experiences and working with veterans in the industry like Mr. Ashok Kumar and many advisors in the financial industry. So MyFix is one such platform, what we call it as a multi-interface financial exchange built on a private blockchain to cater to resolve the problems in the financial industry. So now coming to the features of blockchain and how we are addressing those things, I will just go to the same points given over here. How we are establishing the trust. The blockchain as such, it's a immutable ledger and it's transparent because of the way blockchain is being built. It is decentralized and distributed. So we have the nodes are deployed in all the participants, and everyone is going to see the same data near real time. And because of those things, we'll be able to achieve the trust. So directly coming to that one, of course, the programmability part of the requirement is where we are addressing the smart contracts, is where what we discussed about the BREs. I think our gentlemen here were talking about the BREs, and again, bank doing its own underwriting and NBFC doing its underwriting. Then we're discussing about level 1, level 2, those things. So how exactly all these problems can be resolved is by the concept. One of the features of blockchain is the smart contracts. So the rules and what are the BREs are required are coded as part of the smart contracts, and this has been acknowledged or endorsed by all the participants. So that is where the concept of bank and NBFC agreeing upon the same rule and how exactly it's been executed comes under this one. So rest of the things about coming to the other features of blockchain is about the accuracy.
Before we get into the other features, I want to dwell upon the smart contract piece, which is the core of everything that we will discuss on blockchain. Smart contracts are routine procedures. Routine procedures, what you run inside your own data center to do EOD, BOD and all that. Except that in smart contracts, it can execute it on your behalf in somebody else's data center, inside somebody else's firewall. Yesterday I was talking to the group and I was giving this analogy. You can make smart contracts work in such a way, and to solve this simple problem, Mahesh also articulated it, Archana also talked about it. How do you underwrite at the same time? And how do you access two systems at the same time? I'm a big fan of Harry Potter. Harry Potter, Professor Dumbledore, when he gives lectures and he writes on the board, everybody's notebook gets written automatically. That's what blockchain can do. That's what smart contracts can do. You agree that the NBFC will take this portion and the bank will take this portion. One representative is in front of the customer and he only gets that one chance to do this, and you want him to do it in that one chance so that cost of operations is kept minimal. You also don't want too many reconciliations and post facto processes to come in to the play. So you want to do it right the first time. So smart contracts allow you to enter into an agreement upfront with space for variations, who is allowed to do what, and it gets coded. In every legal document we have this. Either party can change the terms of this agreement subject to both parties agreeing. That is really in technology possible through a mechanism called the consensus mechanism. So you establish the rules of consensus, you put that into code, and you keep that in nodes which operate within your firewalls. You don't change anything to your backend. Let your processes be, let your LMS be, let your LOS be, whatever it is. But this node that comes into your firewall then talks to your systems. The node in the bank's firewall talks to the bank systems. These two nodes are carrying versions of the smart contract that you have agreed upon, which controls the information which needs to go into each system automatically. It is like that one writing coming on multiple books. This is the concept of decentralized processing on decentralized ledgers. So we are one of the only ones who've interpreted blockchain this way. That's why we're excited about the possibility that a person in front of the customer can capture data. One Aadhaar card, QR code scanning, triggers off the underwriting process in the bank, the KYC process, the SCRIF process, or any other processes that are required to contribute to either entities underwriting the loan on their books. Similarly, when the collection is done, the person getting that money in or the NACH mandate coming in and settling the account, both treatment, the accounting treatments as I've agreed. So the bank probably goes into the general ledger, the CBS, Finacle or whatever. And for the NBFC, it's probably on Tally or whatever the accounting system. So it marks the NPAs, it marks the closure of the loan, it marks the EMI being collected, interest at the same time. And this is not just possible, we've actually tested it and it works in isolation in co-lending models, in direct assignment models. It works in microfinance. In microfinance, we've done 80,000 plus customers loans, about 400 odd crores of disbursement has already been done for Federal Bank. And we've done this in real time for KCC loans, which is a complex process where you have to get the agri land record acquired from the registry and compare it with the land record physically held and underwrite the loan on the bank's system. Co-lending is not part of that process, but we did that in 5 minutes. So it's due to be announced by the Tamil Nadu government. So we've realized that this is possible. So we're trying to see if this ecosystem can come out and see the day of light with people like you who are actually struggling with some of these challenges. Can we make it simple and easy too?
So if I understand correctly, so there's no instance when such transfer happens, it's real time. So it's like a API push having every microsecond for that matter.
Absolutely. And
if I define it in a very layman term,
if you define it in the current technology terms, absolutely right.
Yeah.
But in the blockchain,
I understand. There's no push and pull. That's what you're saying.
Exactly.
Okay, thank you. Thank you all very much. Wonderful discussion.